You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast coming to you from Montecito, California. Weather is now wonderful. Went for a great hike today in the lovely hiking trails in the area, which I highly encourage you to come visit. Come visit Santa Barbara. We should maybe have a meetup here. It'll be kind of fun, right? Yeah, before we begin, remember there's a website, wealthformula.com. That's where you go to get all the goodies. There's some resources there for you, books to download, webinars. Also, that's where you're going to go if you're going to sign up for the Accredited Investor Club. Now, the Accredited Investor Club, it is a place where you go if you're interested in potential deal flow. I do need to tell you this, that there is going to be quite a bit of deal flow coming down the pipe as blood begins seeping through the streets of the real estate market. On the multifamily side, certainly, we don't do office and we don't do that kind of thing. Those are already hemorrhaging. Those are already on CPR at best. But anyway, but then what about single family homes? We never talked about those. And it's probably worth talking about. And because it is different. It's a different world, right? And what a crazy, crazy ride it's been for single family. Despite COVID, plunging interest rates actually made home prices explode to new highs. In my own quaint little neighborhood of Montecito, prices literally doubled. It was madness, complete madness. Then it started to look like the housing bubble had started to burst. Still not in my neighborhood, but in the rest of the country. There were mortgage companies in distress, laid off thousands of people. Economists warned of the next housing recession being upon us. It all made sense, actually. After all, after such a wild ride, how could that not end up with a hangover? But then a funny thing happened. For the last few months, housing prices actually started creeping up again. Weird, right? Well, they aren't going up by much, but the big thing is they're not going down despite these super high interest rates now, relatively speaking, of course. A lot of this is really due to reduced inventory and buying pressure. People who are going to sell their homes, in the last couple of years, most of them likely sold because they saw their quote unquote largest asset, their homes, bubble into a pile of potential cash. Why wouldn't you sell? If you were going to sell, then was the time to sell, right? And now with less inventory, bidding wars are helping to push prices up further. In fact, Zillow predicts home prices will keep rising in 2024. Obviously, a lot of that's going to depend on what the Fed does in the next few months, and we'll see what happens, right? I'm not sure. I don't know. Who knows? Maybe Zillow knows more than me. This stuff is really difficult to predict, and that's why I got my guest on this week's show. He is a guy who has a company that works using big data, and he'll define exactly what big data is as well, to look at the housing markets, specifically the single-family home market. So anyway, it's an area we haven't really discussed much about. Make sure you tune in right after we come back from these messages. Welcome back to the show, everyone. Today, my guest on Wealth Formula Podcast is Mike Simonson. He is the founder and president of real estate analytics from firm Altos Research, which has provided national and local real estate data to financial institutions, real estate professionals, and investors. That can be found at altosresearch.com. Michael, welcome to the program.
Thanks, Buck. Nice to be here.
So your focus is on this concept of big data. Maybe you could explain to us, just the beginning, what exactly is big data and how is it generated?
Well, yeah, what Altos does is we track every home for sale in the country every week. So, it's the pricing, it's the changes in the pricing, it's the supply and demand and all of these things. That turns out to be valuable because if you look at the traditional way that the housing market was tracked, it was looking at the homes that sold last month, the closed sales last month.
Sure.
And, while there's some signal there's a ton of signal in the active market. The how long are they taking on the market? Which ones have had price cuts? How big are those price cuts? There's all this signal that was never tracked before. And so, we have this capacity to track a lot more data and understand more about the market and where things are heading. And is it a good time? All these questions about the market now. And that's really, the power of big data.
Yeah.
That we
now,
get to do.
Does that include multifamily, or is it just single family homes, or?
What we track single family and multifamily condos and townhomes, and we also track things like investment property, like apartment buildings, like the small unit apartment buildings, like 1 to 4 or 8 units.
Right.
When we're doing broad analyses about trends, there's actually not a lot of those, 1 to 4 units compared to how many total homes there are on the market. And so it's a lot harder to do a trend on, say, apartment buildings. It's only like LA County has a lot of them, but most of the country, there's 1 or 2 here or there that are on the market at any given time.
Got it. And is there, for example, for people who invest in, significant apartment complexes, things like that, is there data that you can extrapolate to that, or is
what we do on the apartment complexes side is we track rents.
Yeah.
And so, we can watch rents around the country and how those are changing week to week. And it's a lot of, there's signal in that as well. So, we can look at, you can look at the pricing and the changes in rents, and you can, there's a lot of insight to begin there.
Sure.
When we're talking about like big apartment complexes, those transactions are even more rare.
Right.
And therefore it's like, that's a very specialized kind of data that you might be tracking.
Right. Sure. So, let's jump into it. What is the, when you look nationwide, what kinds of information are you getting right now? What kind of signals are you getting? So
the biggest theme of the year is the available inventory of homes on the market has been dramatically lower than we expected. Fewer homes available to buy, and available inventory has been falling for a decade, really, since the beginning part of the last decade. Each year, fewer and fewer homes on the market, fewer available supply for people to buy, for home buyers to buy, for investors to buy, because we've been hoarding them, we've been owning them more. Investors are buying more, even when it's like, when I go to buy a next house, I keep the first one for an investment property. All those things take homes out of the active inventory. They keep them we keep them owned. They're not resold.
So here in where I live in Montecito in Santa Barbara area, and one thing that anecdotally, I have no data to say this, but basically, it would look like what happened was anybody who was even potentially thinking about selling sold when there was so much froth in the market, right? Yep. And now it's like, okay, well, rates are going up and everything, and so anybody who was who's going to sell probably sold, and now all of a sudden their rates are so much higher, and potentially, although not where I live, the values are starting to fall because people can afford less homes, right? And so that's like locally, at least when I think about what's happening, that would explain that. But do you see that explanation potentially as more of a national explanation, or no?
So it turns out that last year when rates spiked, we saw prices adjust down, right? We saw affordability got way out of whack, and prices adjust down a little bit. And we expected that to continue this year, expected to have inventory to continue to rise. We had demand stopped cold in the second half of last year. And so we expected demand to continue to rise. But what happened was it did not. We had more demand than we had supply this year. And we still have, we have less than we started, less inventory available now, which is normally the peak of the year. and we have less inventory available now than than New Year's weekend, right? Like so we've had more demand across the country than we have had supply this year. And so
has that sort of
artificially
kept prices up in a way? Because normally you would expect, in these situations, if rates are going up, then maybe the value of the properties are going down. But then if you have less inventory altogether and people need to buy a place, then they have less competition. And so that would sort of keep prices up higher?
That's exactly right. Like the quantity demanded, even at these rates and these prices, has been higher than the quantity supplied this year. And so inventory has been falling. And I think there's a few things that go on, like people who are buying now are, they're stretching to make the payment, but they can make the payment. And then they're rolling the dice. If rates go down in 18 months, then they can refinance, and that only gets cheaper for them.
Right.
So like those are the calculations that people have been making this year. And so they're finding a ways around the higher rates in order to make to do the buy that it's like time to buy the house.
Is this, what are you seeing like as, obviously this show there's a lot of real estate investors, right? And so if you look, we always talk about how real estate is generally local, right? And so this national data is great, but like when you look at, individual markets, what looks like, which markets look like they are potentially ripe for investors?
This year, it was the big change of the last year. We had the boom markets. We had the Western U.S., South and West, Phoenix and Austin and Boise. These were all the big boom markets during the pandemic.
Sure.
And they slowed the fastest last year, second half of last year. Denver and Salt Lake and like all of these markets slowed really dramatically last year. Almost all of those recovered this year, but the real strength through that process, through the second half of last year and the beginning of this year, were the Central and Northeast markets. Inventory never rose in those markets. We had buyers buying those, and I think those are often more affordable, in Ohio and those kind of places where, that they weren't as far out of whack as affordability got in Austin or even Phoenix. And so you could see that. So there's, we have investor competition in the same places that we have regular home buyer competition. It's, investors are buying in Phoenix. And then when the rates spiked, the investors stopped very quickly.
Mm-hmm. Has that affected the prices there?
It did. And though they have recovered this spring because with almost all of those markets, places like Phoenix and things have recovered. Demand, like supply has fallen. People have been buying the things that are available. There was the top of the pricing came off. So, all of a sudden, if you're an investor, the cap rates got out of whack last July. Then all of a sudden you could see like, oh, I can get a little discount. And now it's back into my buy box. And so those were bought. They were like gobbled up very quickly this year. Any amount of home price adjustment in those destination investor markets, investors were there with cash ready to compete.
Yeah, that's been an ongoing, theory, and we'll see how it plays out. That obviously there's quite a bit of distress in multifamily and apartment complexes, which we're involved with in that space, and that even despite the economic issues that surround these properties, that the values may not drop as much as we would predict, simply because there's so much demand, so much money sitting there waiting to get deployed.
That's my observation,
yeah.
Especially in the single family, that side of the investor pool. The bigger complexes that have variable rate interest, like those, there's still a lot, I think, of pain to happen there.
Sure.
But nobody who owns, smaller properties in the US has variable rate interest. And so every one of those investors has a really good deal. And you can really see that, right? You could see the big investors, the big Wall Street investors stopped most aggressively. The onesie twosies slowed way down. And the middle range investors, the ones that are professional investors, they own 50 or 100 doors, kind of that size company, those barely slowed at all last year.
Yeah.
And so, the professional investors that are, that run that business they were like, I buy houses and I'm going to keep buying houses. And you could really see that. None of those categories, the big, middle, or small size, none of them were active sellers.
Sure.
Right. They're still holding.
Yeah. Yeah. Well, and in that end, like if you have a great rate on your house that you bought during this period, and all of a sudden rates have doubled or tripled or whatever, why in the world would you sell now and trying to get into another house with a much higher rate, right? Like it just doesn't make any sense. So,
yep.
With your data, what are you seeing on the renter side? What are you seeing, like say, shifting demographics, that kind of thing when it comes to renters?
We had the thing that surprised me most this year is how household formation has held up. And therefore that is, while our rent appreciation, was skyrocketing during the pandemic, year over year rents were going up, 10 or 12 or 15%. That year over year appreciation has come down a little positive. So like 2-4% kind of growth on rents. But it didn't fall negative, right? So like I've been continued to be surprised that, we've had recession signals, but we haven't had, like, people are still fully employed and incomes are still going up. And we have all of these things that have continued to provide support for that I wasn't expecting, but they're still there. We can see that in things like the migration paths have slowed. The California people buying in Austin or Phoenix have slowed, but they're still there.
Yeah. Yeah. Can your data can you pick up signals of recessionary activity and that kind of thing with the data that you're collecting?
That's a good question. We track the houses. We track the homes for sale. And so in some ways, there are the ways that housing is connected to recessions. It's actually lagging in a lot of cases. So, one of the ways we might finally see some available inventory for investors or for home buyers would be, you have distressed sellers, people lose their job and they need to, they have a mortgage they can't afford and they need to sell the house, or they're an investor and, they're upside down on something and they need to unload some of those properties. But what happens is that distressed inventory can take like 12 or 18 months after the start of the recession before you see the inventory. You think about it, like you've got a house now. Let's say you bought an investment house and now you lose your job and you lose your renter. And now you're struggling but it's like, I'm going to get a new job. Well, I don't get a new job for 90 days. Now I stop making my mortgage payment. And now it's another 90 days before I even start talking to the bank. It's 6 months after the big parts, job loss parts of the recession, before I even start talking to the bank. And then it might be 6 or 12 months after that before it gets forced into sale or those kind of things. So a lot of times the housing market is lagging recession, certainly in inventory, like distressed inventory. And so, for people who have been bearish on housing, which there have been a lot of housing bears in the last year, and afraid of bubble conditions or, affordability, right? And so those folks who are thinking there's a recession coming and therefore we're going to see some inventory, we're going to see floods of inventory. Then when we have floods of inventory, prices are going to crash. Like that's the bearish scenario. But the distressed inventory is now looking like 2025 at the earliest, because people are still employed right now. Maybe by the end of the year, they start losing their jobs. Then therefore it's like 2025 before we see that inventory. So if you have that bearish, scenario, like that inventory is probably, 2 years from now.
Yeah. How about building? Do you follow building? Because obviously that has a pretty significant effect, certainly on the rental market, like new availability and competition, all that. So, which markets are having, say, the most success with zoning and building policies and getting things through? I guess that's one question, and then another question would be like, is there building going on right now at the rate that it needs to be?
I'm in the camp that says, we've been underbuilding for the last decade. And we can see that the long-term average was like 1.5 million homes per year that we added. And then post Great Financial Crisis, it was more like 500,000. And now we're getting back close to the long-term average. So we've been underbuilding for the last decade. And you can see some green shoots in terms of zoning and things in especially some of the most challenging states like California and Washington, where they're starting to do some zoning for density, doing multiple unit on single family, like zoning kind of things. So it seems to me that we have a little bit of momentum for some good policy in terms of getting more construction to happen. But there's still we have a long way to go in that front.
And why is that? Tell me why do we need more building?
We have, for all the policy for 50 years in this country, all of the policy, all of the tax law, all of the local laws is designed to favor the owner of the house, right? Keep you in the house, make sure you get a good deal on the house, make sure your mortgages are cheap. Like all of our systems are designed for the homeowner.
Yeah.
And as a result, like that keeps our home prices higher and it makes it less affordable for new families to come in, right? I live in California too.
Sure.
And you look at, kids growing up in California today, if you're starting a young family in California today, it's so out of whack. It's one of the reasons why you have to go buy in Texas, right? Because that's where they're building the houses.
Yeah.
And so policymakers, I think, see that. Everybody can see that the affordability challenge, and so like we're starting to see some of that change there. There's so much momentum against that. In California we have Prop 13, which keeps property tax rates artificially low, and therefore it's even a better deal to not sell my house and to keep it forever. And therefore we have chronic shortage of inventory in California. And it's, Texas has high property taxes. And it's one of the reasons I talk about it's ironically, it's high property taxes in Texas is one of the reasons that Texas has a better functioning housing market than does California. Like it's more expensive to hold your house. So you put it back on the resale market and therefore, there's more opportunity for people to buy. Therefore, prices are lower. Like all of those things happen. And in California, we have, and it's a really good deal if you already own.
Yeah, it's makes for a good rental market in Texas as well. Then, right? I mean, because you're not really worrying yourself necessarily about the property tax changes, although you do experience that through rises in rental costs. What do you see? Like, okay, so. A lot of when you look at big data, I'm curious, one of the things that I would be curious if I was looking at a big set of data like that is like, where's the next, where's the next boom? Where's the next Phoenix? Where's the next, because we have population growth. We have a shortage in housing. You've just talked about how people, started moving out of California and they hit Austin like crazy. No, Austin's really expensive. So where's the next Austin? Where's the next Phoenix?
Yeah. So I'm not, I'll caveat this by saying like, I'm not an investor or a trader.
I don't even mean it as an investor, but I just mean like, where's the next place that's booming? Yeah.
So I think we can see a few things. One is we know the growth markets in the South and East. So the Charlottes and Atlantas and, Tampas. I have colleagues at a company called Resi Shares, which is an investor, a data analytics, data-driven investor platform. And they do the migration and economic and growth conditions. And what they do is they take previously great markets and they say, who looks like that today? So it was like, if buying in Denver 10 or 12 years ago was a really good deal, who looks like Denver today?
Yeah.
And one of their observations, like Tampa looks like Denver today, is their view. And so I think that's a really neat way to look at it.
Yeah.
Based on all of those elements that they can see. And so they direct their, like one of their buy boxes is in Tampa for that reason, because they can see it. And then they also do that. They drive that down into lower, like zip code level. What parts of Tampa are the ones that we're going to perform the best?
Where else? Tampa? We're just curious.
Yeah. So you can see it in markets that are, I'd call them tertiary. So, we had, you had the booms in Denver and Austin, but, Austin is really unaffordable right now.
Right.
And so like you then, but El Paso and San Antonio are significantly more affordable. And so you can see that opportunity shift to those markets from the big focus of the last decade.
Yeah. Got it. Interesting stuff. Michael, tell me about a little bit more about Altos Research, and who uses Altos Research, who are your clients, that kind of thing.
Yeah, so Altos Research, we track every home for sale in the country every week. We analyze all the pricing and the supply and demand and all the changes in that data, and then we bubble up the analytics for our clients. We work with realtors and loan officers and people in the industry we do local market data for them to get to their clients. So if you're a real estate investor and you have your realtor, you might be getting your like market report from your realtor that we'd create and prepare for them. We also work with big enterprises like lenders and home builders and hedge funds and the big enterprises that have exposure to real estate across the country, and they need to know right now what's happening in the housing market. Most housing data, traditional housing data, is lagging. It's several months old by the time you hear it. Like the Case-Shiller index, that is the latest headlines now is for March.
Right.
It's March data, and it includes January, February, March transactions in it. But we're at the end of June, and like we can see already what's going to close in July and August. So like that's the kind of reason that you use our data. And I publish each week. I do a video on YouTube and a podcast where I look at the national data and the changes in the national data each week. And so like is inventory climbing? Rates went to 7%.
Yeah.
How is the market responding to that? And you can watch in real time what's happening way before the headlines get there.
And how do you find that? What's your handle there?
Yeah, so on YouTube, it's Altos Research. It's the Altos Research YouTube channel, and you can find it. And I do a video every Monday. You can follow me on Twitter, Mike Simonson on Twitter. I publish that, or LinkedIn. You can find me there. And we are part of HW Media, which owns Housing Wire now. So we were acquired by HW Media last year. And so you can also see the data gets published every Monday and Tuesday in Housing Wire. If you read Housing Wire, you can go there and find that as well.
Thanks, Mike. Appreciate your time. This is good information, and hopefully people will check you out on those various social media channels to keep up with the most current thing, I guess, that you can get out there right now. So Mike Simonson from Altos Research, thanks for joining us, Mike.
Buck, pleasure to be here.
We'll be right back. Welcome back to the show, everyone. Hope you enjoyed it. Just as a reminder, if you want to sign up for our investor club, you should seriously consider doing so and potentially getting onboarded. Obviously, you need to be an accredited investor. You can't just be You do have to have, unfortunately, some net worth or income, $200,000 to $300,000 in income, basically $200,000 if you're single, $300,000 if you're filing jointly, $1 million, or a net worth of $1 million outside of your personal residence. But if you qualify, you should get onboarded. Sign up for Investor Club at wealthformula.com, and you'll get onboarded there. And boom, you'll be in line for things that potentially come up for us. I also want to remind you that there's this podcast called Sapia with Buck Joffrey. Yes, that is the same Buck Joffrey. And that is a podcast that's really focusing primarily right now on the longevity health science space. And it's really interesting. Check that out. You'll be able to find it with the same way that you currently listen to Wealth Formula. And I would certainly appreciate your support there. It's really a labor of love. And I think you'll find it very, very interesting. That's it for me this week on Wealth Formula Podcast. This is Buck Joffrey signing off.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.